Well, as the Reserve Bank raised interest rates by that 0.5% today, it unusually admitted to uncertainty. Now, that's a very un-Reserve Bank-like thing to do. The uncertainty stems from consumer behaviour, where, in the face of interest rate rises and rising consumer prices, households continue to spend at record levels. The Reserve Bank statement today said it will be paying close attention to all this as it assesses future interest rate movements. So let's bring in here one of Australia's foremost economists, Dr. Chris Richardson. Chris, always good to have you on the program. I want to start with that, and I can actually show people the actual part of this statement today where they talked about this uncertainty. If we just bring it up, what we can see it's saying is really they're uncertain just about the way in which consumers are going to react and about what they're going to do with their savings in the future.
Yeah, and that uncertainty is extremely important. If you look at what consumers are doing, well, today's retail numbers are a reminder. They're up almost 11% more that families are spending in the shops than they were a year ago. But if you look at measures of consumer sentiment, how families are feeling, basically those measures are quite sick, not as sick as they were when COVID arrived, but pretty low by historic circumstances. And that's basically what the Reserve Bank is trying to do, to tiptoe along the path to bring the spending down without terrifying families too much about what happens next.
Okay, so I did a calculation today that already, given the fact that we've had a 1.35% increase in interest rates in just 3 months, if you've got an $800,000 mortgage, that works out to $6,800 after tax per year, which is a pretty decent chunk of somebody's income to come out, considering we might be only halfway through these rate rises.
Yeah, and the Reserve was about as clear as it could be that there's more to come. So the Reserve Bank is taking money out of the economy because it's worried about inflation, and it thinks prosperity ongoing will be at risk if we let inflation hang around. Trouble is that the last federal budget we had at the end of March, it was bipartisan. Basically, both sides of politics were putting money into the economy, and then the Fair Work Commission followed up also putting money into the economy. So the wider Australian government, if you like, can't quite make up its mind at the moment whether we need more money in the economy or less money in the economy.
Okay, so then take me to the past. Is there any period in the past that is parallel with what we're seeing now, which might give us a hint as to what the outcomes might be economically?
There are some similarities with the 1970s where you saw energy shocks pushing up prices, inflation taking off, and then hanging around. And to some extent, I think that is spooking the Reserve Bank and its policy making. It's going relatively hard, relatively fast, because it gets scared that inflation starts to get cemented in place, that wages start to follow prices, start to follow wages. And that circularity is a real risk. That's why they're going hard. They could, however, go too hard. And you could see even those marvellous retail numbers we had underscored today start to weaken. You could see the even more marvellous unemployment rate, essentially the lowest in half a century, start to go up again. And walking that path between going too hard and causing a slowdown or even a recession, and not going hard enough and having to continue, if you like, to keep an interest rate squeeze on for longer. That stagflation scenario, they're trying to aim between the two.
So therefore, Jerome Powell, the chair of the US Federal Reserve last week, saying that he would prefer an economic downturn, indeed a recession, as compared with the built-in long-term inflation, unemployment and stagflation. You think that's the same thinking that the Reserve Bank's got right now?
Absolutely. Central banks hunt in packs. And they tend to have much the same thinking at much the same time. You're looking globally at the moment, really the outlier is Japan, which is toughing it out. The problem, though, is that higher interest rates are great at cooling down economies and therefore cooling down the bit of inflation that's caused by strong economies. And we do have a strong economy, and there are other strong economies around the world. But a big chunk of the inflation that Australia and the world faces isn't because of strong demand, it's weak supply. You know, the war over in Europe has had impacts on food food and fuel prices. Floods are continuing to have an impact here in Australia on food prices. What COVID is doing with China and its juggles around that, that's providing ongoing problems. And higher interest rates, whether they're here or around the world, they won't stop that war, they won't stop the floods, and they won't change COVID policies in China. So some of these price pressures will remain around for a while.
I tell you what, Chris Richardson, always good to have in the program, and we shall do it again very shortly.
Thanks, Ross.